Hello and welcome to Financial Intelligence. In this video, I want to talk about double, triple, and quadruple taxation in America. Most people think that they are taxed only once by the government on their income. However, that is not the case in many situations. The complex tax code in the US obscures cases when the same income is taxed more than once by the government. Personally, I consider all sales and property taxes obvious double taxations. Once a person has paid income taxes, they should be able to purchase any product without paying additional taxes. However, in this video, I'm not going to focus on sales and property taxes. Instead, I'm going to focus on only double, triple, and quadruple taxation of income. If you like the type of content that I provide on this channel, subscribe to the channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Let's first define what I mean by double, triple, and quadruple taxation of income. Double taxation is a tax principle referring to income taxes paid twice on the same source of income. It can occur when income is taxed at both the corporate level and personal level. Double taxation also occurs in international trade or investment when the same income is taxed in two different countries. It can also happen with 401k loans. Since the latter two cases are not that common, let's focus on the double taxation of income at both the corporate level and the personal level. The most obvious case of double taxation occurs on dividend payments. A dividend is essentially a monetary reward paid to the shareholders for their investment in a company's equity. The dividend payments usually originate from the company's net profits, while the major portion of the profits is kept within the company as retained earnings, which represent the money to be used for the company's ongoing and future business activities. The remainder can be allocated to the shareholders as a dividend. For example, if you decide to invest in AT&T, you can pay roughly $25 to buy one share of the AT&T company. Since now you are considered a shareholder, AT&T will start paying you a dividend of 52 cents per quarter. This 52-cent dividend payment is your share of profits generated by the company. The challenge is that the company distributes the dividends after paying corporate income taxes to the IRS. Then, when you as a shareholder receive the dividend, the payment is considered as an income and you will also be taxed by the IRS. Simply put, double taxation often occurs because corporations are considered separate legal entities from their shareholders. Note that corporations are supposed to pay taxes on their annual earnings just like individuals. However, when corporations pay out dividends to shareholders, those dividend payments incur income tax liabilities for the shareholders who receive them. This is despite the fact that the earnings that provided the cash to pay the dividends were already taxed at the corporate level. Some folks might think that they do not own dividend paying stocks, so they should not worry about double taxation. However, note that you might be investing in index funds or exchange traded funds that hold dividend paying stocks. For example, if you are choosing to stick with the default target date funds given to you by your 401k provider, you are very likely being double taxed on the dividends those funds receive. Triple taxations are also possible when an investor becomes a shareholder in a dividend-paying corporation that itself receives dividends from another corporation. When a company, let's call them an investor, is a shareholder in another company, let's call this one an affiliate, any dividends the affiliate issues to the investor would face a triple tax. First, on the affiliate level, affiliate pays tax on income. Next, on the investor's corporate level, investor pays tax on income at the corporate level. And lastly, on the investor's shareholder level. The dividends received deduction, or DRD for short, is a federal tax deduction in the United States to prevent companies that are shareholders in other companies from paying a triple tax on dividends they receive from their investment in those companies. However, there are criteria that corporations must meet in order to qualify for the dividends received deduction, or DRD. For example, corporations cannot take a deduction for dividends received from a real estate investment trust, or REIT for short, or capital gain dividends received from a mutual fund. Furthermore, there are also different tiers of possible deductions, ranging from a 50% deduction of the dividend received up to 100% deduction. The bottom line is that if you end up investing in a company that owns another company and receives dividends from that affiliate company, you could end up being triple taxed. This is particularly true if the affiliate company is a REIT or a mutual fund. With the proliferations of subsidiaries and holding companies, it is very likely that you end up unintentionally investing in a company that owns another company and face triple taxation. Lastly, in some cases, you could get quadruple taxation as well. A prime example is when you inherit money from a relative. As you know, the inheritance tax is a levy on assets inherited from a deceased person. The inheritance tax is applied on the value of the inheritance received by the beneficiary, and it is the beneficiary who pays it. Therefore, it adds another layer of taxation that could result in quadruple taxation of income. For example, assume that a person inherited money from a relative who had accumulated their wealth through receiving dividend payments from a corporation that had in turn invested in a REIT or mutual fund. As you can see in the chart, the income the person will receive this way will be taxed 4 times at different levels. First, on the affiliate level, affiliate pays tax on income. Next, on the investor's corporate level. Thirdly, on the investor's shareholder level, which was paid by the deceased relative. And lastly, on the inheritance level by the person who inherited the money. Double, triple, and quadruple taxation is often an unintended consequence of tax legislations. In my view, it is a byproduct of the complex tax code in America. It is generally seen as a negative element of the tax system, and tax authorities should attempt to avoid it whenever possible. I hope that you like this video. If you have any recommendation or suggestion, add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you won't miss any of my future videos. Thank you and take care.